Hey, it's Matt Decker here with Leveraged Wealth Management. Today, we are going to be talking about a topic that I've been getting a ton of questions on the last couple weeks, and so I thought I'd make a quick video, and that is 529 plans and comparing them to some form of cash value life insurance. Most often, we see it compared to indexed universal life. So that's what we're going to be talking about today. Before we do that, though, if you're looking for an IUL policy review, click on that card above this video and it'll take you to my website where you can fill out a short quiz and get on my calendar to do a real quick policy review. The most important thing in buying cash value life insurance is making sure that it's structured properly based on your desired outcome. Having said that, let's get into this video and talk about 529 plans versus index life. When it comes to 529 plans versus indexed universal life insurance policies, there's a bunch of people out there that are only giving you one side of the issue. And as with everything in life, there's two sides to nearly every issue. So this is not going to be a video where I tell you one thing is better than another thing. What it is going to be is an analysis of these two vehicles, what they do well, what they don't do well, and what you can expect if you use them to fund college. And really, the results are going to be nuanced. Which is better? It's going to depend on what you're exactly trying to do. So let's talk about that. 529 plans versus indexed universal life insurance contracts. Let's talk about what each of these vehicles is actually going to be doing and the different kind of pros and cons between these two vehicles. So first of all, starting with the 529 plans, your distributions have to be used solely for education expenses. You cannot use them for anything other than approved education expenses. On the other side of the equation with the Index Universal Life contract, your funds are available at any time for any purpose. It doesn't have to be nailed down specifically to a 529 college-only expense. It can be whatever you want. When it goes to 529 plans, it's not self-completing, right? You put money in every single month or every single year, or maybe you advance fund it with a big single premium. The amount of money that's in that plan is the amount of money that's in that plan. If you die, a year after funding a 529 plan, the only money that's in there is what you've put in. As opposed to an IUL, you're going to have a death benefit. So if you pass away a year or 2 years or 3 years into funding an IUL to help with college, there's going to be a tax-free death benefit that's going to help to pay for some of those expenses. It's a self-completing plan. The biggest one for me, though, is 529 plans are included in financial aid analysis. So when you have to fill out your yearly forms where they give you your expected family contribution, 529 plans factor into that decision. On top of that, 529 plans also factor into merit-based aid, not just need-based aid. So if you've got, a perfect score on your SAT or ACT and you're looking to get some form of merit-based scholarship, colleges look at how much money students have in 529 plans. And if you have two students that both scored the same on an ACT, SAT, and they got one last scholarship to give out, there's a chance that they look at those two students. One has $400,000 in a 529, the other has nothing. The student that has nothing is probably going to get that merit-based scholarship. So 529 plans absolutely are included in needs-based and merit-based analysis when it comes to financial aid. On the other side of the equation, the IUL is completely invisible to need-based and merit-based financial aid analysis. Schools do not see money that's sitting in life insurance contracts when they come up with your expected family contribution. 529 plans can also suffer losses. A lot of times 529 plans are invested in the market. Now that's not good or bad. If you're able to suffer losses, that probably means you're going to have a higher upside, which is true. The 529 plan is going to have a higher upside than the IUL. With that higher upside comes a downside risk, and that's where the 529 plan typically is going to live. It depends on how you're invested inside the 529. Most 529s that we see are invested in the market and can suffer losses. The IUL is a fixed asset. The worst that you can do is 0% in terms of an investment loss. You can get a 0 in some year. You're capped on your upside. So it's a fixed asset, lower upside, and next to no downside versus the 529 plan. The 529 plan is going to limit how much you can pay into the plan. Now you can do an advance or an accelerated payment into a 529 plan, but ultimately there is a maximum amount that you can put into a 529 plan in any given year, or you can bunch some years together and do an accelerated contribution. The IUL, or some form of cash value life insurance, is going to have no contribution limit. So you can put in as much as you want, you can put in as little as you want. There's really no rules there in how you fund the life insurance contract. And because of that, it can be a little bit more flexible down the road, and we'll get to that. Really, the big thing that the 529 plan does have going for it is that you're going to have much lower fees in the 529 plan versus what you would pay in the IUL, where you're going to have all of the death benefit related fees. So the 529 plan, much lower fees than the IUL. The IUL is a front-loaded product. It's probably, and not just the IUL, life insurance in general, it's probably one of the worst short-term vehicles in the world because it's a front-loaded product. You're paying all the fees up front. If you have short-term goals, short-term time horizon, life insurance is not what you want to be looking at. You want to be looking at something with little to no fees, and that's not life insurance, never will be. So the 529 plan, definitely lower fees versus the IUL. So far, this is all just talk, right? This doesn't really mean anything. This is a pro and con list. You're not really gaining much value here. There's not much insight being driven. Sure, there's maybe some nuggets in there, but what I really want to do is I want to show you two of these plans kind of side by side, show you what they can and cannot do. Because as I said at the beginning of this video, what does better mean? Is one better than the other? I don't know. It depends on what you're trying to do. So we have to look at these two vehicles side by side, put them through some kind of similar simulation and see what we get on the other end. Where does the 529 plan win? Where does the IUL win? And how do you determine which one is going to be best for you? Well, ultimately, it's going to depend on what you're trying to do. So let's get into how these two vehicles work, where they perform really well, and maybe where they fall short. So let's talk about that. Let's look at an actual example of a 529 plan and an IUL. So we're going to start with the 529 plan. So this is a snapshot of a 529 plan. Now, what I've done is I've taken a 40-year-old person, they're paying in $12,000 a year into this 529 plan, and I'm assuming a 7% growth rate every single year. So every single year, 7%. That's 7%, and I'm not including any fees, no management fees, no fund fees, nothing, no taxes, because this is a 529 plan. You're not going to pay taxes from year to year. So it's a flat 7%. Now this is in Excel, so if you pull up my Excel sheet, you're going to see times 0.07 to get the growth. It's a pure 7%, and I can't make it any more simple than that. So with this pure 7% growth rate, you put in your $12,000, and you put that $12,000 in for 15 years, and we're getting out $65,000 a year for college for 4 years in a row. Year 16, 17, 18, 19, we're taking out $65,000 a year. That $65,000 is coming out completely tax-free because we're using it for qualified education expenses. Again, we're still assuming that 7% growth rate, and you can see at the end of those 4 years, college is fully paid for with no taxable implications, and you still have $114,000 left over in the 529 plan. So you've put in $12,000 for 15 years, you've got 7% every single year with absolutely no fees. You've taken out $65,000 a year for college, tax-free for 4 years. You're left with $114,000 at the end of college. Pretty simple. Pretty straightforward, but the point is not to show you what's left over in this account after funding for college. The point is to show you how it compares to an IUL, right? Because that's what we're talking about. So let's look at that. Let's see how the 529 plan actually compares to an IUL. So I've done the exact same thing with the Index Universal Life Insurance policy with a few key differences. The same money's going in. It's the same $12,000 for the same amount of time, 15 years. It's the same $65,000 coming out for 4 years. But I used a 6% rate of return and I netted in all the fees. So this is an IUL policy assuming a 6% rate of return every single year, and all the fees are included in this 6%. So we have the 529 plan at 7 with no fees. We have the IUL policy at 6% with all the fees embedded in it. And when we compare these two side by side, they're quite a bit different. So the first thing that you'll notice, the IUL policy has a death benefit. We got a $353,000 death benefit day one. That's why I say this is a self-completing plan. You pay in $12,000, something happens to you, you got $353,000 in tax-free death benefit going to your beneficiaries. That can help with all kinds of things, college included. And you'll notice that the death benefit is increasing as we pay these premiums. We're getting the same $65,000 out, but if we look at the very last year here, year 19, we've taken out the last bit of $65,000. We've taken it out tax-free, just like the 529 plan. How much money do we have left over? We only have $50,000 left over in our Index Universal Life Insurance Policy cash value, $50,973. Now it's true we still have a death benefit, $182,000, but we're not assuming that, this person is passing away. We want to know what's in cash, $50,973. So that brings me to my first semi-universal truth when it comes to life insurance versus a 529 plan. And when you compare life insurance to a 529 plan, almost every single time for short-term accumulation, the 529 plan should outgrow the indexed universal life insurance. Let me say that again. Almost every single time in short-term windows, the 529 plan should outgrow the Index Universal Life Insurance Policy. Why? Well, because the 529 plan has little to no fees, depending on how you're invested. The IUL does have fees. And no matter what, it doesn't matter how you invest, the IUL is going to have fees. Cash value life insurance will have fees, and it's front loaded. The 529 plan, more often than not, won't have very many fees, if any at all. That's number one. Number two, the 529 plan is taking more risk, right? So you should expect, if you're going to take more risk, you should expect a higher reward. And if you're going to expect a higher reward, that's going to come in the form of a higher rate of return. And if you have no fees plus a higher rate of return, you should outgrow the Index Universal Life Insurance contract with a 529 plan. The only times, and I say only, that's loosely, really, if we try to, be serious about this for a second, most of the times, if a 529 plan is not outpacing an Index Universal Life Insurance contract, the reason it's not outpacing the Index Universal Life Insurance contract is because you experienced a large market loss in a later year. That would be one of the only ways that the 529 plan does not outgrow the IUL, because the 529 plan is going to experience market losses more often than not. And so let's say you're 10, 12, 13 years down the road into a 529 plan, and we're comparing two side by side. If you get a negative 20 all of a sudden in some year, your 529 plan is going to go backwards by 20%. The IUL is going to get a 0. So barring that, the 529 plan should outpace the Indexed Universal Life Insurance contract. But really, that's only half of the story, because most people that are using an IUL or some form of cash value life insurance for college funding and for college purposes, they're doing it with really a dual purpose in mind. The goal is to pay for college and still be able to use the money. So let's circle back to having money left over in our 529 plan versus having money left over in our Indexed Universal Life Insurance contract. Those have wildly different and drastic outcomes, having money left over in these two plans. So let's talk about that. So we're back to the IUL snapshot at 6% with the fees. And when you look at this policy, this is basically just the very next year after our $65,000 came out in year 19. We had the $50,000 left over, just like before. But what we want to do now is we want to see, okay, well, this IUL policy, the way that it works is, all your money is still sitting in this accumulation value. You're actually retaining the interest earning power of these dollars. In year 19, you may have $50,000 in cash, but you're earning interest on $345,000, and that number keeps going up. So the power of the IUL really is in the long-term payoff, the long-term strategy of being able to not only pay for college, but also leverage the cash value, leverage the accumulation value inside the life insurance contract for a lifetime stream of income. And if we do that, we're able to generate $24,000 a year tax-free with no market risk from this Indexed Universal Life Insurance contract, assuming a 6% rate of return with all the fees baked into the cake. $24,000 a year tax-free with no market risk. How can we do that? Because we're retaining the interest earning power of our dollars. In year 26, we're earning interest on over $500,000, and that number continues to climb. So this is a drastically different scenario, having money left over in a life insurance policy versus having money left over in a 529 plan, because we already know money left over in a 529 plan has to be used for education expenses. Well, What if we want to use it for supplemental retirement income? Now we're in a whole nother ballgame. This is a whole different category, because if we want to take money out of our 529 plan to supplement retirement income, we have to pay taxes, number one, and we have to pay an additional fee, a 10% penalty for using those $529 for something other than college distributions. So it's a totally different scenario. It's a wildly different comparison, but let's kind of see how the 529 plan keeps pace with the IUL, because I think that's a worthwhile consideration. Before we go to the 529 plan, I should point out that this $24,000 goes all the way out to age 93. I wasn't trying to mislead. On the previous slide, we stopped at age 74 here, but I ran out of room. The $24,000 keeps going, and I should point out at age 93, we've got $562,000 left over in cash with a $670,000 death benefit. But the point here is, how long can a 529 plan mirror this $24,000 income stream? And when we go to the 529 plan at 7% with no fees ever, no market losses ever, 7% every single year, we leave off at the $114,000 just like where we were before. That continues to grow at 7%. We try to take out $24,000 a year. Okay, well, here's where we run into problems, because that $24,000 coming out of this 529 plan, if we're using this for supplemental retirement income and not college expenses, we're 66 at this point, it's no longer tax-free. Not only is it not tax-free, we have to pay taxes plus a penalty. So the penalty is 10%. Depending on what your tax bracket is, that's what you're going to pay on the other portion. So 10% plus your ordinary income tax filing status. So I'm just assuming a 25% all-in rate here. So you're at a 15% rate and then a 10% penalty, 25%. So if we do that, $24,000 comes out, we're going to have to pay $6,000 in taxes. You're still going to get your 7% growth. And really, at $24,000 a year out of this 529 plan, you may have left off with more than twice as much money in year 19 compared to the IUL. But replicating the income stream is extremely difficult, because now it's not a tax-free vehicle. And we actually run out of money at age 72. The 529 plan is completely exhausted. So how is that possible? The reason the 529 plan is completely exhausted when we start taking income out in retirement, and we use it for retirement, not college expenses, is because when you pay that $65,000 to the college out of the 529 plan, that $65,000 leaves your account. You're no longer earning interest on that $65,000. So yeah, you may end up with more money in the end, $114,000 versus $50,000. That's true, and that's the point. The 529 plan should outgrow the IUL. You should have more money left over at the end of it in a 529 plan versus an IUL if you just put them head to head. The problem is, what do you now do with that money? And in a 529 plan, there's not much you can do with that money. You can try to turn it into supplemental retirement, but you're going to run out of money well before you would ever run out of money in an IUL policy. And that is the benefit of the IUL. It's a long-term vehicle that can generate long-term tax-free income streams, and the 529 plan simply can't do that. It's not built to do that. So the question that I have is, okay, at 7% with no fees, we run out of money at age 72. What would we have to earn inside a 529 plan, netting out the taxes for the penalty and just ordinary income if we try to use this for retirement? What would we have to earn inside this 529 plan to match the IUL from a cash standpoint, income standpoint, and a death benefit standpoint? And the answer, I think, is going to shock you. In order to basically match the 529 plan's income and remainder value to the IUL, you are going to have to earn over 9.1% every single year. Over 9.1% every single year just to match the IUL remainder value at age 93 and match the income stream. And that 9.1% that you have to earn needs to be net of fees. 9.1% every single year with no market losses ever. If you throw in a market loss that completely changes these numbers, 9.1% every single year, net of fees, in order to match the IUL, college distributions, plus the $24,000 in income, plus the $500,000 that's left over in cash at age 93. So my question is, 529 plan, IUL, college funding, which one is better? Man, I have no idea which one is better. What I do know is that they are wildly different, and based on your goals, the answer to that question is going to be different. If you just want to accumulate as much money as possible in a short time frame, the 529 plan is a better way to go. If you have a longer time horizon and you're hoping to use this money for college and supplemental retirement income, the IUL, by far the better way to go. So hopefully this has been helpful, and hopefully I've kind of brought light to both sides of this issue. There's not a right answer. It really comes down to what are your goals for your dollars? What are you trying to do? What are you trying to achieve? How much risk are you comfortable taking? And if we can answer those questions, we can come up with which one of these is right for you and your situation. So if you have any questions at all, I'm going to put a link at the top of this video. You can click on that link, it takes you to my website. You can ask me any questions that you might have. You can get an IUL policy reviewed. You can see if this is a strategy that might be something that's worthwhile for you. As always, please like and subscribe to my channel, like this video, share it with your friends, and let me know in the comments what topics you want me to cover next. I look forward to seeing you in the comments. Thanks so much for taking time with me. This is Matt Decker, Leveraged Wealth. We'll talk to you next time.